Hello, welcome back. Hope you had a nice weekend. In this video, we are taking a look at AMD. It's a very interesting company that has been going down in terms of its stock price. You can kind of see it here in the 5 years chart. And also, if you take a look at the 1 year chart, you can also see pretty much the downtrend. It's been a downtrend for AMD for a long while now. It's down about 50% since its 1 year high, and actually even more since its all-time high. So is this one a buy? At some point it used to be super expensive, but obviously we're going to be taking a look at what is currently happening at its current stock price. Now, if you take a look at the P ratio of the company, it's sitting at 41, which potentially indicates that it's expensive, or the company may be expensive. In some situations, though, if there are some other things about the company that are potentially nice, it may not be expensive. It really depends. It depends on a lot of stuff like margins, how much money the company has in its coffers, a lot of other things like the revenue, the net income, the free cash flow. So we're going to be taking a look at this holistically pretty much and see whether a company like AMD is actually worth a buy right now. Okay, so the PE ratio is actually 41.5, but take a look at where it was back in 2017, for example, where the company was massively overpriced. So currently, it's looking like it's getting significantly better, with the price to free cash flow also going down. And at some point, it used to be negative because the company was actually losing free cash flow. Then it became very high because the company was making money, making free cash flow, but the stock price was very expensive. Right now, it's sitting at 35, potentially indicating that it may be a nice period actually to potentially buy AMD over here. Now, a thing that I don't like to see, of course, is the massive outstanding shares increase. The company has been issuing tons of shares, basically funding themselves with a lot of new issued shares. And so if you bought back in 2019, for example, or even 2020 over here, you have been massively diluted. And this is something that really sucks for stockholders, shareholders. And the company hasn't slowed down. They have actually accelerated their stock issuance. And it's weird. So this is back in 2020. We can kind of take a look at the 3 years chart. Yeah, actually it does make some sense because it's over here where the company stock price was super expensive. So the board found an opportunity to actually issue more shares here and fund themselves. Now, semiconductors obviously a cash hungry business here, and so this kind of opportunity was seized by the board. And it's bad for stockholders, for shareholders, of course. But currently, at this current price, being at $70, I don't anticipate that the board will keep issuing shares. It doesn't make a ton of sense as the stock price is actually down almost 60% from its all-time high. Now, the total liabilities to free cash flow is very low, 1.5, which means that when you compare the free cash flow of last year, that the company generated last year, to the total liabilities that they have, that includes debt and every other liability that the company has, it's 1.5 years of last year's free cash flow that they would require in order to pay back all their total liabilities, which means that they're very solvent. And you can kind of understand that because the company has been issuing shares to pretty much fund themselves and actually have this as a substitute for potential loans. So they don't really borrow money. They prefer to actually issue shares. Both are bad. Issuing shares is cheaper for a company, but obviously it's not great for shareholders. So, pick your poison pretty much. Now, the revenue growth of the company is something that you like about AMD. The company has been in an uptrend pretty much in how much they are growing. And when you compare it to companies like Intel, for example, which is bigger, significantly bigger than AMD, this one is still growing. And so this is very appetizing here, very attractive. And the net income growth is also very appetizing for the company, with the free cash flow growth also pretty great, and the total equity growth. Again, this is backed by the outstanding shares. So the company has issued tons of shares, which means that their equity grows. That's how it happens. But the debt that the company has is very little and actually goes down and down and down and down. So they don't have pretty much almost no debt over here. And in terms of the return on equity, you'll see here that these values are fairly low over here, and the margins of the company have been on the decline. Again, all the semiconductor companies, remember what happened with Intel last quarter. They got completely destroyed. I mean, they have really lost a significant chunk of their business. I suppose it has a lot to do with the pandemic, the lockdowns, and everything. But you can kind of see here that the margins of AMD have also been suppressed, and typically they are significantly higher I mean, if you take a look at since 2019, they have been near 25%, and then they started pretty much going down and down and down. Okay, so what about the actual financial statements of the company? What's going on here? If we take a look at the revenue, again, it's something that I talked about earlier. The company's revenue has been increasing massively. 3 times is what they are doing right now compared to 2017, which is amazing, from 5 to 16.4, almost more than 3 times actually. And if you take a look at the net income, you will see that they started at 43 million and they're currently sitting at 3.16 billion in 5 years. That's tremendous growth, as you can understand. So it's awesome to see over here. In terms of the balance sheet, it's basically the story of pretty much the issued shares. You can kind of see it here, the additional paid in capital in the billions, because the company has been issuing shares, more and more shares, pretty much not stopping for any reason, frankly. They don't have any debt though. You'll see that the total debt is actually going down, and it's less than a billion, almost half a billion over here, which is basically nothing. And if you take a look at the equity, this has been increasing mainly because of the additional paid in capital, sitting at $7.5 billion, sitting pretty much is what AMD is doing here. But it's very, very important to see what's happening with the cash flow, because the net income of the company is positive and the operating cash flow is about the same. Small adjustments here, just some stock-based compensation, some depreciation, amortization, few things, frankly, some inventory, pretty much spending some money to buy inventory here, and slight changes in working capital. Pretty much is the net income is basically what you get here for the operating cash flow. And in terms of capital expenditures, very, very little capital expenditures from AMD. It's in contrast to what Intel is doing, for example, which is spending tons in capital expenditures. And it's one of the reasons why the stock has been going down quite a lot. And it's currently having about 700 million spent in investing activities over here, very normal stuff. And in terms of the net cash from financing activities, $1.9 billion is what they spend over there. Mainly for, actually, as you'll see here, repurchasing some stock, but they have also been selling stock. So it looks like they're doing some repurchasing as well. But overall, they have been a massive, pretty much net issuer, pretty much, of stocks, of shares. And that's obviously one of the bad signs for the company as a stockholder. Now, that's not bad for the company, but it's bad for the shareholder, again, because of the the illusion that you're getting. And the free cash flow, again, sitting at $3.22 billion. Now, if we go back at the metrics page, I kind of wanted to take a little bit of a look at potential dividends that the company is paying over here. And this company is actually not paying any dividends, my bad. So let's actually take a look at our stock evaluator. And you will see here that we're getting a pretty much a very nice summary of what the company has been doing. The revenue of the company has been insane. The growth has been tremendous, but again, you cannot expect this kind of numbers growing from 16 billion. This is not going to happen. And so for our revenue growth, again, these values have been superb, pretty much, because the company has grown tremendously in the past 5 years. But this is not going to continue forever, obviously. And again, this kind of 3 years, this has been crazy over here. So we're going to go with something that's much more normalized, much more normal, and see what we get from here. So something like 5, 6, and 8, I suppose it makes a ton of sense. What about the net income margin? So here, you can kind of see here that as the company has been growing, their margins have been getting better. Now, we saw that recently, that's the recent few quarters, it's actually been going down to about 10%. But overall, it looks like they grew themselves from like 1% to 5 over here, 25, 19. Now it's going down again because of the issues that they are having. So we don't really have a great average for the company here. So I kind of want to use a few different cases here. So what will happen if the company generates like 12%, 15%, and 18% for the next 5 years? Again, more than likely, this is probably going to be even more potentially than 18%. I think that this may actually be near 20% when the dust settles. But again, we want to be conservative and see what happens in this situation. And in terms of the free cash flow margins over here, we are sitting at 100%, 30% over here, which is the odd one out, 80%. I'm going to go 80, 90, and 100. It looks like the company is typically doing something like 100 to 80 to 100. And again, there will be some years that are out of the ordinary because, for example, the company could be buying extra inventory. So, for instance, you will see a shift in the free cash flow margins. But overall, it looks like we're sitting at near 100% based on the expenses that we saw earlier, the adjustments that we saw earlier in the free cash flows. Now, the annual return that we want to be asking for is about 13%. And if we hit calculate, what are we getting? Now, if we calculate, you'll see that the current price sitting at 70 bucks, it's still expensive for what we would want it to be. It would be nice if we could get this one at $30, $34, $35, something of that sort would make a ton of sense. Now, this is conservative. If somebody wants to try, and again, anybody who has access to our tool can try their own projections. You can get access by becoming a Patreon. The link is in the description box below this video, of course. But what I quickly want to try is what will happen if the company actually goes back to much better revenue growth. Let's just say they do 10%, 12%, and 14%. Now, this may be a little bit of an exaggeration. I don't think they will likely achieve that for the next 5 years. That would be a lot, maybe. But the margins that I'm going to try is also 18, 19, and 20%. Let's just say that the company actually goes back to something that seems to be closer to what they're doing. And what are we getting in this case? And so in this case, we're getting something that is a high of about 48 bucks, which is still a red compared to the current price, about $70. So I think AMD becomes interesting near $30 to $40, frankly. But as it's sitting right now at 70, it's probably a little bit more expensive than I would like. But stay tuned, I will soon be making a video about Intel too, which is a competitor that has been going down quite significantly, and potentially MU too, that's Micron. Maybe some other semiconductor companies if people are interested. But thank you for watching, and I'll see you in the next video. Bye bye for now.